Hi, let us discuss Essay 514 Accounting Estimates. There are certain items in financial statement which cannot be measured precisely but only can be measured with the help of estimates. For an example, provision for doubtful debt. For our limited purpose of this standard, such financial statements are referred to as accounting estimate. Financial statement items, if it is based on accounting estimate, then there will be a possibility or susceptibility of estimation uncertainty which will have an effect on risk of material misstatement of accounting estimate. It is the duty of an auditor to find out the estimation uncertainty. As far as any accounting estimate is concerned, whether it is a fair value of accounting estimate or a normal accounting estimate, there is a difference between the outcome from the accounting estimates and the amount which is recognized in financial statement may be erased. Why? Because accounting estimates are based on certain assumptions, methods, and sometimes it may be based on management experts which may be differ. It's quite natural. It is need not necessarily be a misstatement in the financial statement. What are the objective of the auditor? The thumb rule of accounting estimate is the accounting estimate should be reasonable. It should be free from the management bias. For that purpose, auditor has to obtain sufficient and appropriate audit evidence whether accounting estimates including fair value of accounting estimates are reasonable, related disclosure in the financial statements are adequate, sufficient and relevant, it is adequately disclosed in the financial statement. Definitions. What is an accounting estimate? An approximation of monetary amount. An approximation of monetary amount in absence of precious means of measurement. The terms is used for an amount measured at the fair value where there is an estimation uncertainty. What is the auditor's range or point of estimate? An amount or amounts which is set by an auditor based on the audit evidence obtained for evaluating management range or point of estimate. It is designed for solely for the purposes of evaluating management estimate and identify whether there is any estimation uncertainties exist and also confirm the accounting estimates are reasonable. What is an estimation uncertainty? The possibility or susceptibility of an accounting estimate and its related disclosure to an inherent lack of precision in its measurement. If it is lack in its precision in its measurement, then it is called the estimation uncertainty. At the time of estimation, management measurement is not precious. What is management bias? Lack of neutrality by the management. What is management range or point of estimate? The amount selected by the management for recognition and disclosure in the financial statement as an accounting estimate. What is an outcome of accounting estimate? The actual monetary amount which result from the resolution of underlying transactions and events. Let us have a close looks on net realizable value and fair value. As per accounting standard 2, NRV is the estimated selling price in the ordinary course of business less estimated cost of completion and estimated selling cost. Fair market value is a price that an asset that ordinarily fetch or liability could be settled in an open market between knowledgeable willing parties in an arm length transaction. Net realizable values is an entity specific measurement. However, fair market value is a market based measurement. Let us have a look on risk assessment procedure and related activity. Auditors shall obtain an understanding of the following in order to identify and assess the risk of material misstatement. What are the requirements of applicable FRF with respect to the accounting estimate? How management identify those transactions, conditions, events that may give rise to the needs for accounting estimate? How management prepare the accounting estimate? What are the assumptions? What are the method? Or is the management use management experts documentation? Auditor shall review the outcome of accounting estimate in the prior period and make necessary adjustment during the current period to reflect the exact amount, either making extra provision or writing off as the case may be, it is required. What are the overall response to the assessed risk of material misstatement SA 330? Based on the assessed risk of material misstatement, auditor shall determine whether the management has appropriately applied the applicable FRF, whether methods are relevant, sufficient and appropriate and have been applied consistently. A response to the significant risk estimation uncertainty. For accounting estimate that give rise to the significant risk of estimation uncertainty, auditor has to evaluate the following: how management has considered alternative assumptions or outcome and why it had rejected by them, whether significant assumptions used by them are reasonable. If in the judgment of auditor the management has not adequately addressed the effect of estimation uncertainty, the auditor shall develop a range with which to evaluate the reasonableness of accounting estimate. Measurement and disclosure related to the accounting estimate. Auditor shall obtain sufficient and appropriate audit evidence about whether the accounting estimate and the related disclosure in financial statement is appropriate and relevant. For the accounting estimates that give rise to significant risk of uncertainty, auditor shall check the adequacy of disclosure of their estimation uncertainty in financial statement. What are the additional disclosure provided to address the estimation uncertainty in the financial statement? Indicators of possible bias by the management. Auditor shall review the judgment and decisions made by the management and ensure that it is free from the bias of them. Written representation. Auditor shall obtain written representation from the management whether management believes significant assumptions used by it in making accounting estimates are reasonable. What are the matters to be documented? Auditor's documentation shall include the following: the bias for the auditor's conclusions about the reasonableness of accounting estimate and their related disclosure that give rise to significant risk of estimation, and indicators of possible management bias if any. Let us have a summary of SA 540. To check valuation and disclosure of estimates including fair value of estimate, auditor should understand the requirement of FRF, management procedure, outcome of the last year accounting estimate, examine the compliance with FRF, methods applied by the management appropriate and consistent, and significant risk. Examine the alternative assumption, examine the reasonableness of assumptions adopted by them, develop a range, check whether uncertainty has been disclosed by the management, check bias by the management, written representation. Assumption by the management are reasonable in their opinion. The basis of conclusion whether an estimation is right or wrong, indicators of the management bias. Reporting. Difference between auditor's range and estimation by the management. Asks the management to adjust. Not adjusted, then qualify or adverse audit report. Otherwise, adjust. A clean audit report. This is our discussion about standard of auditing. Thank you for watching the video and have a nice day.